Hi there. I'm Robert Promisel, one of the global portfolio managers at Resolution Capital. Today I'm joined by Jeffrey Olson, who's the chairman and chief executive of Urban Edge Properties. I've known Jeff for over 25 years, and really pleased to have an opportunity to speak with him, have him share his view for his company. So just briefly, Urban Edge had its IPO in 2015. It's been a long-standing operating company before that. It's a $4 billion portfolio today, just over 75 assets, just about 17.5 million square feet. The majority of the portfolio is located in the eastern U.S. between Boston and Washington. Jeff, I wanted to turn it over to you to introduce your company and maybe just talk a bit about the investment focus of Urban Edge.
Sure. Well, thank you for having me, and we appreciate your interest in Urban Edge. I think what differentiates Urban Edge from most of our peers is our focus on these densely populated areas. Yes, the majority of our portfolio is in the DC to Boston corridor. It's primarily concentrated around the New York metro markets, the suburban markets. The data point I like using is that our average 3-mile population density is 218,000 people, which is about twice the industry average. And it's because we're in these highly dense marketplaces. And what I like about being in dense markets is that the supply constraints are so severe. So it's hard for retailers to enter into these types of markets because they're already fully built out, especially if they're looking for a store that's greater than 10 or 20,000 square feet. So a core part of our thesis is owning in these densely populated markets. And generally, we find we get higher rents, we have more stability, and the demand is greater. In terms of the shopping center space, I've been in it now for 25 years, and this year, I would say, is the year that is demonstrated the most in terms of demand for space. So it's the strongest leasing year I've seen in 25 years. And I think what happened was COVID accelerated the demise of so many of the weaker retailers that we went into the year without much of an at-risk tenant profile. And what happened is the stronger retailers ended up taking market share from the weaker retailers. Right before this meeting, I did a quick chart that just simply looks at the stock performance of our top 10 retailers since February 2020, which is right before COVID hit. And if you just look at the average stock price of our top 10 retailers, Rob, our top 10 retailers are up 32%. That compares to the S&P 500 at about 13%. So they've outperformed by a wide margin. And those retailers include the likes of Home Depot and TJ Maxx and Target and Lowe's, among others.
Right. So tenant credit really has been cleansed as you went through COVID. Okay. And as a provider of capital to your tenants, obviously that's pretty good for you. One thing I wanted to ask about, you mentioned your focus on markets with supply constraints and very strong, very large household densities. Do you have a sense of the inventory per capita? And the reason I ask the question is my sense would be that your markets, some of the inner ring suburbs of Metro New York, would be seen as underserved relative to other retail areas in the U.S.
Yeah, I've seen studies that show that our supply per capita is about half that of the U.S. average. So yeah, there's definitely less supply.
Right. Okay. So the other area that I just wanted to touch on was just the format of your centers. It's not exclusively, but it's predominantly open air, which I think would offer convenience for your customers as well as some cost advantages for tenants. And maybe you could just talk a little bit about how you see the open air format evolving from here, where it's been before COVID, and how you see the uses going forward.
Yeah, I mean, the open air format has proved to be quite resilient, especially during COVID. And what we're finding and during COVID was the online fulfillment that took place within our stores accelerated, and retailers wanted to have exterior entrances. So we really saw a separation of retailer performance compared to, for instance, the indoor mall space, where a lot of the mall retailers decided they wanted to be in open air centers primarily so they could service their customers with external entrances. And we're continuing to see that as a trend. We also saw during COVID a lot of box demand from grocery stores, because of course people weren't coming into the city as much, so they were eating at home more. And so, during COVID, we were able to open more grocery stores than any other type of tenant category. And today, about 2/3 of our centers are anchored by grocery stores. And then we also have another 10% that are anchored by either Home Depot or Lowe's, which in my view, sort of act like a grocery store in many ways too, in terms of bringing tenant traffic.
Right. I would imagine, the productivity of those grocery stores are commensurate with the underpenetration of retail in your markets.
Yeah, so specifically, our grocers are generating about $900 a foot in sales, which I know is the highest in the REIT sector. Yeah, big numbers, and more coming too.
More coming. Okay, that's quite an anchor. The other thing I wanted to talk about with your company was just the opportunity to redevelop, expand, and really upgrade the centers over time. Some of the properties are on really quite large swaths of land. Maybe just talk a little bit about your development and redevelopment expectations and plans.
Yeah, we have high expectations to upgrade our centers. There are a handful that look like they're still from 1985 and need to be upgraded, and a lot of the rationale behind when we decide to upgrade a center has to do with lease expirations. So if an anchor lease is coming due and we have an opportunity to either bring on a new tenant that's a better tenant or renew the existing tenant, but hopefully at a higher rent, and hopefully it gives us an opportunity to redevelop that center, we will do so. What we're squarely focused on at the moment is, during COVID, and this happened to many of our peers as well, our occupancy rate dipped to about 91%. Today we're about 95%, and that's a leased number, it's not occupied. And we think we're going to get back up to our historical average of 97 to 98%. And when you convert that to numbers, like, we think today we can increase our NOI by 10% simply by the leases that have been executed, but where rent hasn't commenced yet. So, I mean, those leases are done. If we were selling an individual shopping center with an executed lease, we would expect to get full credit and value for that. So we've got a 10% increase in NOI coming just from the executed leases. And then we have another 15% of rent coming from leases that are under negotiation. So we think that our NOI is going to go up by about 25% from executed leases and from leases that are under negotiation. A lot of that is redevelopment oriented, where we might be taking a vacant Kmart or a vacant Toys R Us store and replacing it with somebody like a Target or a TJ Maxx or a ShopRite. So we think there are multiple benefits of doing that. And it's going to cost us, for all of that, probably around $400 million. But we're also going to get about a $58 million uplift in NOI. And
$58 million.
And it will result in much higher traffic. Obviously, a vacant Kmart isn't bringing that much traffic to a center today. So we're expecting that there will be another uplift in rents as those tenants open, and then we're able to relet the surrounding stores.
So quick math would suggest that your development would yield roughly 15% as that NOI comes online.
Yeah, and we don't put it all in the development category. The development category, that we put into our supplemental, we think that's closer to a 10% return. Some of the other leases, I wouldn't consider development leases. It's just leasing vacant space without putting in a lot of capital.
Okay. And then what's the time frame for the signed but not yet occupied to start to cash flow?
I mean, it's already beginning, but all of this is over a 3 to 5 year time period.
Okay. Great.
I wish I could accelerate it. It takes time to get done.
No, that's a nice differentiator, I have to say.
When you look at the rankings in this space too, because there are some analysts that actually quantify, they call it an SNO pipeline, signed but not open. We are the highest in the space.
Sure. I have to ask take a different tack with the next question. Sure. So forgive me in advance, but I mean, let's just talk a little bit about the current economic environment as we sit in late 2022. I'd have to say that there are mixed signals about the economy, certainly the U.S. economy. We have tight labor market, we have household debt that's still comparatively low, but inflation is been higher than people would have wanted it to have been in for longer. And so the Fed reaction has been to raise rates really quite aggressively. And that perhaps portends an economic slowdown. I mean, we don't know, but it does seem like that growth would be set to slow. That's what the Fed is looking for. So with that as a backdrop, I'm just curious how you would anticipate managing through that. Maybe you could comment on how your asset class has done historically in periods where economic growth has slowed. Since that seems to be what's up.
Yeah, no, I'm happy to address it. So the first priority gets back to getting this 25% uplift in NOI. So 10% of it is baked. The other 15% that's under negotiation, I've instructed my leasing team to get those deals done. And get them done now. I don't want to fight over the last nickel because I do think there's a chance that things could slow down next year and retailers may not want to expand as quickly as they wanted to this year. So I think it's important to get those leases done. Secondly, going through the downturn, through the great financial crisis, what I saw then was that the local shop retailers were the ones who were most vulnerable. They didn't have access to that much capital. And they were the ones that closed down first. This portfolio has less shop exposure than my prior portfolio at Equity One, and it's mostly comprised of national tenants. And I would expect this portfolio would be more resilient because of the credit profile we have within our rent roll. But we are preparing for tougher times ahead. I think it's smart. The retailers have not slowed down yet. They have not announced any material changes in their expansion plans, but I think it's sensible to manage towards that.
Right. So you're pulling forward the leasing where you can. Yeah, that makes sense. The last topic I wanted to just talk to you about is a topic that's really important to us at Resolution Capital, to our clients, and I think it's becoming more important to the real estate community more broadly, which has to do with ESG considerations. And your portfolio, it's some of the assets are older, and so I think it's just an interesting challenge as we move towards improved environmental metrics in terms of measuring carbon emissions. And I know that this is an area that you guys have been spending more time and putting more attention on.
Yeah.
Can you just talk a little bit about what your expectations are on an environmental side for such a well-located infill portfolio as yours?
Yeah, yeah. Well, as you know, we did our inaugural ESG report last year, and we went through the GRESB process. We were actually able to increase our score significantly this year, so we're now in line with all of our peers. But I'll tell you, from an ESG standpoint, where my heart matters the most is what are we doing inside of the communities. And when I look at a center like Bruckner, which is in the heart of the Bronx, one of the lower income areas in the Bronx, we had a center that may have been one of the ugliest centers that I had ever seen ever. And we invested $75 million into that center to bring the first ShopRite to the Bronx. And ShopRite is the best grocer in the New York metro area. And we also did a facade upgrade on the balance of the center and made it look brand new. It could go in any suburban neighborhood and you would think you were, elsewhere. And when that ShopRite opened, we had a line of about 150 people waiting to get in. And there were tears in shoppers' eyes because for the first time, they were able to buy affordable food at a reasonable price and high quality food too. So when I look at, our company's mission, it is improving retail real estate in urban communities. And that's probably the best example of us improving a community. And people that live there are so proud to go to that center today. We redeveloped it. There are really 3 phases to it. We finished phase 1, which was bringing in a grocery store. Phase 2, we're finishing upgrading the other side of the center. And then we have a final phase that Kmart was in, which occupied a large building and a Toys R Us. And we're in the process and hope to announce very shortly new tenants for those 2 locations. So improving communities to me is at the heart of what we do. And we're very much focused on that.
That's great progress. Great progress. Jeff Olson, Chairman, Chief Executive of Urban Edge Properties. Thank you. Thank you very much.
Great. Thank you, Rob.
Have a good day.